Nasdaq futures are pointing to a brutal implied open this morning, currently down 1.5%. The S&P 500 is desperately clinging to that historic 7,500 plateau in the pre-market, but the momentum we saw earlier this week has just completely evaporated.
Yeah, it's gone.
The overnight session was dominated by a single unavoidable catalyst. Tonight, at midnight, the Jerome Powell era of the Federal Reserve officially ends and Kevin Warsh takes the wheel.
A literal midnight transition.
Exactly. And it is Friday, May 15th, 2026. You're joining us to decode a stack of highly sophisticated institutional-grade strategy notes we just pulled from the bulls, bears, and the bell desk. We are navigating what they are officially dubbing the Great Transition. But I want to start with the hard data here because you cannot understand why the market is stalling at 7,500 without looking at the numbers that just hit the tape.
Right, because the data creating this pre-market anxiety is just a brutal tug of war right now. I mean, we came into the week riding the tail end of that, that Goldilocks rally.
That assumption that economic growth is perfectly stable and inflation is finally tamed.
Exactly. And then the actual data hit. Tuesday's CPI print came in incredibly hot at 3.7%, but the real shocker, the absolute landmine, was yesterday's PPI.
Yeah, the producer price index ripped to 6.0% year over year. And I really want to pause on that 6.0% because that is a massive, massive number.
Huge.
The market had already priced in a 2.0% GDP print, right? So we know the economy is broadly expanding. But if businesses are growing, aren't we just looking at a side effect of a healthy economy? Like, why is the smart money suddenly treating a 6.0% PPI print like a catastrophic event?
Well, because the PPI measures the cost of doing business before the product ever reaches the consumer. If it costs, factories and logistics companies 6% more just to operate, that cost is eventually going to bleed directly into the CPI.
It gets passed down to the buyer.
Every single time. The market has been trying to look past these recent inflation bumps, assuming the Fed would eventually just pivot to rate cuts to protect that 2.0% economic growth.
But Warsh changes the math.
Completely. If we connect this to the bigger picture, the arrival of Kevin Warsh changes that entire calculus. The institutional desks are calling it hawkish uncertainty.
Hawkish uncertainty.
Yeah. There is a very real fear today that Warsh might look at these sticky 3.7 and 6.0 inflation numbers and decide that protecting growth is just a secondary priority.
So instead of incremental rate cuts, he might prioritize a shock and awe balance sheet reduction.
Exactly. He could forcibly drain liquidity from the system to just kill this inflation spike before it becomes permanently embedded.
And draining liquidity means making money significantly more expensive. Which brings me to the next massive red flag in these desk notes. The 10-year Treasury yield is screaming higher. It just broke out to a fresh one-year high of 4.54% this morning.
And it's dragging the dollar up with it.
Right. Simultaneously, the DXY, the dollar index, is tracking heavily toward 99.00. But let's break down the mechanics of that for the listener, because a strong dollar sounds like a good thing on paper, right? But the real risk here is what it does to multinational earnings. Why is a DXY hitting 99.00 an active threat to the S&P 500?
Because a strong dollar is actually a severe headwind for the mega-cap companies that make up the bulk of the index. Think about a massive American tech company selling software in Europe or hardware in Asia.
They're collecting euros and yen.
Right. And when the DXY surges toward 99.00, the value of the US dollar is rising against all those foreign currencies. So when that multinational brings its foreign profits back home and converts them into dollars,
they literally get fewer dollars.
They get hammered on the exchange rate. It actively erodes corporate earnings on paper, even if they sold the exact same number of units.
That makes the stakes incredibly clear. The market is priced for absolute perfection at 7,500, but corporate earnings are about to take a hit from the currency exchange while borrowing costs are surging past 4.5%.
It's a toxic combo.
It is. But let's look at the root cause, because we aren't just talking about abstract monetary policy here. The strategy notes point to a very physical, very dirty reality driving that 6.0% producer inflation. And that's energy.
Yeah, the physical commodity markets are flashing warning signs that you simply cannot ignore right now. I mean, energy costs are surging across the board. We are looking at Brent crude holding stubbornly above $107 a barrel.
And WTI oil is broadly hovering over $105. And I'm looking at the notes regarding the ongoing geopolitical conflict involving Iran and the fact that the Strait of Hormuz remains this massive choke point for global supply.
The primary choke point, really.
Right. But I'm honestly confused by the market's reaction here. because we just saw the U.S.-China summit conclude. They announced the Trump-Xi-Hormuz Accord. Now, just reporting on that impartially as a diplomatic event, it was explicitly designed to act as a ceasefire, right? To ease tensions in the region.
That was the stated goal, yes.
So if the diplomats are shaking hands and signing accords, why is oil still pinned above $105? Like, shouldn't the market be breathing a massive sigh of relief? Are the markets calling bluff on the diplomacy?
Oh, the physical commodity markets do not trade on handshakes and photo ops. They trade on actual barrels of crude moving through the water. I mean, you can sign a diplomatic accord, but until the maritime insurance premiums for oil tankers navigating the strait actually drop,
The price of oil isn't going to budge.
not an inch. The risk of disruption is still way too high. They are demanding proof. Traders are looking at the mixed signals coming out of that summit and deciding that the structural reality on the ground just hasn't changed enough to warrant shorting oil.
So they're maintaining a massive conflict premium.
Exactly. Because the cost of being wrong, like getting caught without oil during a sudden geopolitical supply shock, is catastrophic for an industrial economy.
And this brings us right back to the mechanics of that 6.0% producer inflation. When crude is pinned at $107 R, it's not just the price of gas at the pump.
No, it's everything.
Right? It means the diesel fuel for the shipping containers costs more. The petroleum used to manufacture plastics costs more. The fertilizer for agriculture. The factory paying for electricity to keep the assembly line running. It compounds at every single stage of the supply chain.
Which is exactly why the institutional money is pouring into the XLE right now.
The Energy Select Sector SPDR Fund.
Yeah. It is currently the strongest institutional hedge against these geopolitical black swans. I mean, with crude eyeing an 8% weekly surge, the desks are signaling that if your portfolio isn't participating in the physical energy flow right now, you are left entirely exposed to the inflation risk. Energy inflation is no longer transitory.
It's structurally embedded.
Highly embedded.
And that structural reality leads us to an absolutely massive clash of titans happening in the pre-market tape right now. Because these macroeconomic forces embedded inflation, a surging dollar, and a 4.54% treasury yield are directly threatening the single biggest engine of the market. The tech rally is under siege.
What's fascinating here is that the prevailing narrative of the last 10 years has been this idea of tech as a safe haven.
Right, the assumption that software and digital platforms could outgrow any economic pain.
Exactly. But that narrative is fundamentally breaking down before our eyes.
The desk has drawn a hard line in the sand for Nasdaq futures today at 26,500. And I love the way the strategy notes frame the vulnerability of tech stocks here. It's exactly like a physics problem. Think about companies like NVDA and Cisco. They are the massive rocket engines that have provided this historic upward thrust to the market.
The thrust has been incredible.
But the 10-year treasury yield, that is gravity. If gravity hits 4.54% and keeps pulling harder, it honestly doesn't matter how strong the AI engines are. The rocket gets pulled back down to Earth.
That analogy perfectly illustrates the mechanism of a discount rate reset. Tech valuations, especially in the artificial intelligence space, are essentially long-duration bonds. You're buying them today based on the massive profits they are projected to make, 5 or 10 years in the future.
But how does the 10-year treasury yield mathematically crush those future profits for the listener?
Well, the 10-year yield represents the risk-free rate of return. If you can get a guaranteed 4.54% return from the U.S. government,
Which is massive.
right, then you are going to demand a much higher potential return to risk your capital on a tech stock. As the yield goes up, the present value of those future AI dollars mathematically shrinks. Investors run the numbers and realize they're overpaying for growth that might take a decade to materialize.
And we are seeing that gravity pull on NVIDIA this morning. They are chasing a historic $6 trillion market cap. The desk points out that the AI industrial cycle is no longer just a speculative trend. It's a very real $700 billion a year capital expenditure cycle.
A massive CapEx cycle.
Yet, NVIDIA is seeing pre-market profit-taking, sliding 1.2 to 1.5%. The bull case here is 242.00, bear case 228.00.
And the desk notes this slide is largely driven by China approval volatility. NVIDIA previously saw a huge spike on rumors that advanced AI chip sales to China might be approved.
But as we head into the weekend, with Warsh taking over the Fed,
the algorithmic traders are actively de-risking. The technicals are breaking down under the weight of those yields.
Then you look at the other side of the AI infrastructure trade with Cisco. They're actually up 2.2% in the pre-market. They just posted a massive Q3 earnings beat driven entirely by hyperscaler networking demand.
Yeah, that demand is insatiable right now.
Let's quickly define that term for a second. Hyperscalers are the massive data center operators. Your Amazon AWS, Microsoft Azure, Google Cloud. They are buying Cisco's networking equipment at an unprecedented rate. Bull case for Cisco is 62.50, bear case 57.00.
But the internal mechanics of Cisco's quarter are what make this really fascinating. To capture this hyperscaler demand, Cisco is simultaneously cutting 4,000 jobs.
Wow.
Yeah, they are actively carving out massive portions of their legacy business to pivot 100% into silicon and optical AI infrastructure.
And optical infrastructure is the physical reality of the AI boom. You can't move the insane amount of data required by artificial intelligence over traditional copper wires. They would melt, or you'd just lose the signal.
You literally have to shoot lasers through fiber optic cables.
Cisco is laying the physical optical pipes for the global AI brain.
They are the prime example of the physical build-out of the digital revolution. But here is the vulnerability. Even with a massive earnings beat and a ruthless, successful corporate pivot, Cisco is still subject to that 4.54% gravitational pull.
Because the capital required by those hyperscalers gets more expensive.
Exactly. The capital required to keep buying Cisco's optical equipment gets vastly more expensive when borrowing costs remain elevated. If Warsh forces rates higher to fight the 6.0% producer inflation, the entire $700 billion capex cycle slows down.
So with tech valuations buckling under the weight of higher yields, let's pivot to the actionable strategy for the session. The desk expects today to be incredibly volatile, and they highlight a massive divergence between what everyday retail investors are doing and where the institutional smart money is actually hiding.
The S&P 500 line in the sand today is 7,475, and the institutional call for the opening bell is that we are looking at a classic liquidity trap.
Okay, what does a liquidity trap look like in real time for the trader watching the screen today?
It looks like a gap and go that immediately fails.
A fake out.
Right. The expectation is a fake breakout above 7,515 early in the morning. That green on the screen is designed to draw in eager retail buyers who think the tech rally is resuming.
But then what?
It will be followed by a severe midday drain of liquidity. Institutional traders are going to sell into that strength. They're aggressively hedging their books against the political risk of the Fed transition over the weekend.
So they step away, the bids disappear, and the retail traders are left holding the bag at the top.
Right.
And speaking of holding the bag, this brings us to the most dangerous concept in the strategy notes today. It's what the desk is calling the retail pain trade. Everyday investors are aggressively buying the dip on long-dated bond ETFs, specifically the TLT, which tracks 20-plus year Treasury bonds.
Oh, this is such a brutal setup.
Their logic is seemingly sound, right? The Federal Reserve is done hiking short-term interest rates, so rates overall must have peaked. Therefore, it's time to lock in long-term bonds before yields fall and bond prices rise.
It sounds incredibly logical, but it is a fundamental misunderstanding of how the debt markets actually operate. It leads directly into a trap the institutional desks call the bear steepener.
I want to spend some time here because this is the exact mechanism destroying retail portfolios right now. Break down the bear steepener. Why does buying a supposedly safe U.S. government bond trap retail investors in a bleeding portfolio?
Because the trap is assuming the Federal Reserve controls all interest rates. They don't. The Fed controls the short-term overnight borrowing rate. But when you buy a 20-year or 30-year Treasury bond, you are dealing with the free market.
And right now, the free market is terrified of the long-term future.
Exactly. They are looking at the 6.0% PPI, the embedded energy costs, and the massive geopolitical friction. This creates an explosion in what bond traders call the term premium.
Let's use a concrete analogy for the term premium. It's like lending your neighbor $100.
Yeah.
If they ask to borrow it for the weekend, you probably don't charge them interest. The risk is incredibly low.
Right.
But if they ask to borrow that $100 for 30 years, and you know the cost of groceries, housing, and gas is going to skyrocket over the next 3 decades, you aren't just going to hand them the money.
No way.
You're going to demand a massive premium, a huge interest rate, just to ensure you break even on the purchasing power you lose to inflation.
And that is exactly what the institutional bond market is doing to the U.S. government right now. The bond vigilantes are saying, sure, the Fed might pause short-term hikes today, but inflation is going to erode this money over the next 20 years, so you need to pay us a significantly higher yield to lock our capital away.
And because bond yields and bond prices move in opposite directions, when those long-term yields surge to compensate for the term premium, the actual price of the long-term bond ETFs collapses.
The yield curve is steepening, and it is acting like a vicious bear market for long-duration bonds. Retail investors who bought the TLT thinking they were buying the ultimate safe asset become duration trapped.
Duration trapped.
Yeah, they are caught holding an asset that is plummeting in value even though the Fed isn't technically hiking rates anymore. They are actively locking in their own losses.
That is a terrifying realization. You try to do the responsible thing, you buy the safe asset, and you get chopped to pieces by the term premium. So if retail is bleeding out in long-duration bonds and overextended AI tech stocks, where is the institutional money actually flowing this morning?
They're executing a highly specific flight to quality. The strategy notes highlight a massive rotation into defensive, dividend-paying equities. And the prime example the desk is targeting today is Walmart. Bull case 131.50, bear case 124.000.
Walmart. You are rotating out of silicon optical infrastructure and $700 billion AI CapEx cycles to buy a grocery store.
Well, you don't buy the rocket ship when gravity is crushing you. You buy the utility that society cannot function without.
But let's frame this not as a stock tip, but as a macroeconomic lens. Why Walmart specifically?
Because the smart money moving into WMNT isn't just a stock trade. It is an institutional bet on the psychology of the American consumer during the Warsh era.
Trading down.
Exactly. As embedded inflation from that 6% PPI continues to pinch consumer wallets, institutions expect a massive wave of high-income consumers to start trading down. Families that used to shop at premium grocery stores will inevitably shift their spending to Walmart to stretch their dollars.
So Walmart benefits from the economic pain of the middle and upper middle class.
It is the ultimate pragmatic play where cash is parking to weather the storm.
So bringing all of this together for the listener as we approach the opening bell, the ultimate takeaway from today's strategy notes is capital preservation. The transition of power at the Eccles building tonight is the only catalyst that truly matters.
Period.
You have to watch the 10-year Treasury yield. If it decisively breaks and holds above that 4.54% level today, the desk is explicitly warning that the exit doors on this market are going to get very, very small.
Do not let the algorithmic gap and go lure you into chasing the early morning green. Keep your position sizing small. Today is a day to let the institutions fight it out while you protect your downside.
And that leads me to a final thought I want to leave you with as you watch the tape today. We've spent an entire decade operating under the ironclad assumption that technology is the ultimate safe haven. We believe that no matter what geopolitical chaos erupted, software, hyperscalers, and digital platforms would simply outgrow the economic pain.
That was the playbook.
But if that narrative completely fractures under the gravity of the new Warsh Fed and a world of structurally embedded energy inflation, what does the next generation of market leadership actually look like? Are we witnessing the definitive end of the digital gold rush and the painful necessary return to the physical economy, to commodities, to heavy manufacturing, to the unglamorous things you can actually touch?
If the term premium continues to explode, the physical economy might be the only place left to hide.
Something to heavily consider before you deploy capital today. The old captain is stepping down, the new captain takes the wheel at midnight, and that massive storm system of inflation and geopolitics, we are officially sailing right into it. Good luck out there today.